Did you know that inflation has silently wiped out nearly 50% of the US dollar's purchasing power over the past 30 years? That means if you had $10,000 sitting in a bank account back then, its real value today is worth half as much. And in times of economic downturns, that erosion speeds up, leaving unprepared investors scrambling to protect what they've built. But here's the good news. You don't have to be one of them. If you want to shield your money from inflation and downturns, you need a strategy, not just luck. And that's exactly what we're breaking down today. Let's start with a harsh reality. Cash is not king in an inflationary world. Holding too much in low-interest savings accounts means you're guaranteed to lose purchasing power over time. Instead, the key is to put your money where it can outpace inflation. Historically, that means assets like stocks, real estate, commodities, and inflation-protected bonds. Take Sophia, for example. 5 years ago, she had $50,000 in a savings account earning less than 1% interest. Meanwhile, inflation averaged 3% per year. Over those 5 years, her money lost over 15% of its purchasing power without her even touching it. But her friend Daniel took a different approach. He diversified his savings into a mix of index funds, REITs, and Treasury inflation-protected securities. Tips. The result? His money grew instead of shrinking. So how can you build an inflation-proof strategy like Daniel? Let's break it down. First, invest in assets that benefit from inflation. Stocks, particularly companies with strong pricing power and consistent earnings, tend to outpace inflation over time. Commodities like gold and silver, as well as real estate, often rise in value during inflationary periods. And for a more conservative approach, tips. Treasury inflation-protected securities adjust with inflation, ensuring your purchasing power stays intact. Second, diversify globally. The US economy isn't the only game in town. Investing in emerging markets, foreign currencies, and international stocks can hedge against domestic downturns. When the dollar weakens, foreign assets often become more valuable, balancing your portfolio. Third, protect your income streams. If all your income comes from a single job, you're exposed to major risk during recessions. Developing multiple streams of income through investments, side businesses, or dividend-paying stocks creates a financial safety net. The wealthiest individuals never rely on just one income source, and neither should you. Fourth, cut debt that doesn't serve you. In times of economic uncertainty, high-interest debt can be a financial trap. Focus on paying down variable rate debt first, since rising interest rates make it even more expensive over time. But smart debt, like fixed-rate mortgages on rental properties, can actually work in your favor, as inflation erodes the real cost of repayment. Finally, stay liquid, but not in cash. Economic downturns bring opportunity, but only for those who are ready. Instead of sitting on piles of cash, consider high-yield savings accounts, money market funds, and short-term bonds. These options keep your money accessible while still providing some level of return, so you're prepared to invest when opportunities arise. Now, here's where most people get stuck. They hear this advice, but don't take action until it's too late. Inflation and downturns don't wait for perfect timing. The best time to fortify your finances? Yesterday. The second best time? Right now. Which of these strategies are you already using, and which do you need to implement? Drop a comment below. I'd love to hear your thoughts. And if you found this helpful, you're going to want to see what's next. Click on the video on screen, and let's take your financial knowledge even further.